sinking feeling you get when you think the smart thing you've been doing for years was actually just a little bit expensive. If you love dividend income but hate paying the tax, you're going to love these. I'm Brian, CPA. We're 15 years in finance. I'm going to walk through return of capital versus dividend. Here's a scenario. You've got $100,000 in a regular taxable account, not inside TFSA or RRSP where none of this matters. You want 5% yield. You're choosing between two stocks, let's say. Both pay you $5,000 a year. One pays eligible dividends. The other pays return of capital or ROC. You hold for 10 years, same cash in your pocket every year, but very different tax bill. Your exact tax bill will depend on your own rate. The dividend stock, you're paying about $2,400 a year in tax every single year. Over 10 years, that's $24,000 in taxes. Oh my God. If it's fully accounted for as return of capital, that would be zero tax annually, so nothing. Now, people hear return of capital and go, Brian, that's just me getting my own money back, isn't it? Well, let me show you why that's not quite right with the actual accounting, and this is where the accounting actually matters. Simply put, all a dividend is a corporation's profit. A company earns money, pays corporate tax, gives you what's left. That's income to you. It's taxable. ROC works a bit different. Here's what actually happens. So let's say a REIT, in this example, REIT owns a building, costs $1 million. Every year that building depreciates, say $50,000, non-cash expense. Doesn't cost anything, but it reduces profit on paper. Meanwhile, the building's generating rental income. Cash comes in, but because of depreciation, there's less taxable profit. The real estate is paying you from cash flow, not profit. Economically, you're pulling the building out in cash piece by piece. And that's why the CRA doesn't tax it as income yet. For tax purposes, it's treated as your own capital coming back to you, so the tax shows up later as a larger cap gain. Your adjusted cost base goes down. When you sell, bigger gain, bigger tax bill. Back to the $100,000 example. After 10 years of ROC, your adjusted cost base is now $50,000. You sell for $100, that's $50,000 cap gain. If your gain is under $250, it's taxed at 50% inclusion. Tax in this case is $13,500. Total tax over 10 years with ROC is $13,500. Total tax with dividends, $24,000. You're saving almost $11,000. It's good to watch the ticker. A lot of these will split partially ROC and partially dividend income, but anyways, I'm not saying one's necessarily better. It's just important to understand how you're taxed at the end of the day. Please like and follow for more content like this.